Good morning and welcome to your Monday, September 9th market news update. Significant downward revisions of June and July NFP figures fueled another wave of outflows from US stocks. Crude plunged 8% last week, hitting one-year lows as slowdown fears from the world's largest economy spoils optimistic demand outlooks. Money markets remain divided over a 25 BPS or 50 BPS cut from the Fed in September after mixed jobs data yet resolved for the jumbo cut fades. Orange juice futures stick close to record highs as the uprise of the citrus greening disease in both Brazil and the US aggravates supply shortages. Deflationary pressures persist in China, pressing equities lower by almost 1% in today's market open. Below expectations, GDP growth in Japan weighed on the yen, interrupting its rally towards fresh YTD highs. Finally, producers' prices in China fall the most in 4 months, leading to discontent about the persistently weak state of domestic demand. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 9th of September of 2024. These are the key events that you should familiarize yourself before starting your own trading day. The first topic of conversation is going to be about crude oil, which has slumped near year-to-date lows. Now, WTI futures have plunged to the lowest level since the start of the year, and they actually went a little bit further down than that. We have seen them plunging into an area last seen before at the second week of December of 2023, so rounded about year-to-date lows. This happened at the start of last Friday's kind of session, as we saw exacerbated fears for depressed demand levels globally for the energy commodity in the foreseeable future, which has supercharged record levels of speculative short positions against it. Now, traders have turned increasingly bearish against crude oil so far, with the primary reason being the continuous stumbling around all over the place of China and its inability to rise up to the occasion and fix the situation post the destabilizing period that we have seen few years ago with the COVID-19 pandemic. And we also saw their recovery progress hitting speed bump after speed bump, jeopardizing, in other words, its highly anticipated return back to normality and in the global arena, which again, this discourages investors from allocating capital. So some may say China is not investable for this at this period of time. We highly disagree with this, but this kind of negative kind of outlook and sentiment surrounding China has been going on for quite some time now, and is having a material effect on prices of crude, mainly because it's one of the, if not the largest oil-consuming nation around the world. So if they're having trouble and they cannot keep up in regards to the manufacturing industrial capabilities, it's reasonably expected to see some plunges of crude, reflecting those fears of lower demand, but also maybe it could be due to higher supply at the same time. So there are a lot of macroeconomic factors affecting the price of crude. my primary one that we see investors kind of being worried about is this China, but also not only that, in recent days we have seen developments in the United States adding salt to injury as we saw rising fears for a steep slowdown, more specifically of the US economy, as a series of unfavorable labor market updates pointed out that the world's largest economy's job creation capabilities are indeed cooling down, right? Giving rise to fears that this is going to is actually breeding and fueling market discontent and forcing traders to downsize and downwardly revise their medium to long-term WTI horizons, mainly because they fear that it's going to be some sort of a recession or a pullback of economic activity in the United States. And since we're talking about the largest economy of the world, and it's definitely a large, thirsty consumer of oil, we see depressed projections for WTI's price over the medium to long term as well, reflecting those fears for a slowdown. Okay, we have to note nonetheless that currently there exists a lot of tactical but also technical overextension rationale or belief around crude oil's trading levels. Hence, we saw the sharp 8% pullback or contraction, whatever you want to call it, for over the past week for whatever reason. We wouldn't be surprised to see abrupt unwinding of this excess short selling activity taking place in the near future for, again, whatever reason. And it wouldn't be surprising to see a strong rebound of WTI north of the $72 per barrel level, at least at the initial phase of the rebound, as you could reasonably expect some sort of de-buying opportunity taking place, mainly because you see it going south and south and south, session after session. Sometimes you're going to hit a technical overextension level, oversold levels, and again, you're going to see some people entering the market for a deep buy opportunity and possibly lifting it once again back to those levels you had, relatively speaking, smashed with ease over the past few weeks. Okay. Finally, we're going to close this session by pointing out that tomorrow, Tuesday, we're going to see the latest OPEC Plus monthly report. It's going to be released, but also the EIA's EIA's short-term energy outlook report is going to come out also. Both of which data points will or are expected to be studied closely and analyzed closely by crude traders in order to update their horizon and targets in regards to the energy commodities future. Okay, so these are the two releases that we highlight in tomorrow's session. Going to have a material impact, but also we're going to keep track of the geopolitical but also economic news developments that arise from China and the United States, the two main largest economies of the globe, which do have a direct implication on their performance, has a direct implication on the performance of crude as well. Okay, so leaving this as it is, and we move forward to the next topic of conversation. We're going to do a week ahead schedule because today we don't have any major economic news releases apart from what we have already had in today's early Asian session with China's CPI and PPI updates, but also from Japan's GDP releases. Okay, so going past today's Monday's releases, pretty much you don't have anything left. Moving on to Tuesday, we'll make a start with China's trade data report in the early Asian session, superbly important, tied to the topic we've just discussed with crude. Also, we know the UK's employment data and the latest monthly OPEC Plus report we just mentioned as well. On Wednesday, we move on to UK's GDP print and the highly anticipated US CPI print, inflation update from the United States for the month of August. Superbly critical because we are edging closer and closer to the banks, central banks, the Federal Reserve's first crucial monetary policy decision, which we're actually expecting for them to go ahead and slash rates, whether it's going to be for 25 or 50 basis points. Time will tell. The meeting is coming up soon. Tomorrow's release of the CPI print for the month of August is certainly crucial because it's going to give us a clear sign of whether the central bank is not debatable whether it's going to cut rates or not. The debatable aspect of this kind of conversation is by how much. Okay, and what is to follow from here onwards? Are we going to see some disinflationary trends crippling into the United States economy, which is going to entice the Fed to go ahead and just do a jumbo rate cut in order to get things started with resolve? Or are we going to see some sort of signs of reacceleration of inflationary pressures, slight at least, which is going to put Fed officials on their back leg, pondering whether to just dip their toes slightly in the water and just go for a 25 basis points rate cut instead of the 50. Okay, again, this is going to be the main event tomorrow, but also we're going to see the PPI update again from the United States. Also important to see an update from the producers side of things on what's going on with inflationary pressures. Okay. Thursday, we highlighted possibly the main event of the week is going to take place, the European Central Bank's interest rate decision for their September meeting. Most likely, we're going to see the ECB slashing rates once again after their June meeting, possibly for another 25 basis points. And after this event tomorrow, we're going to have PPI. Okay, sorry, I mentioned PPI for Wednesday. It's actually going to be on Thursday from the United States. Finally, Friday, we close the show with Eurozone's industrial production rates. From my point of view, is important, okay? And the preliminary leading indicator updates from the University of Michigan. What we're talking about here is consumer expectations, consumer sentiment, current conditions, but also the 1 and 5 year inflation expectations. All of this is crucial data because it's leading. It's giving you indication, it's giving you a glimpse of what's happening currently, boots on the ground in the United States. What is the outlook and the optimism that consumers do have in regards to the trajectory of the US economy, their sentiment, their expectations, and how actually things are, but also their expectations about inflation. Okay, so superbly important data week coming up. Hopefully, as we go through the week, we're going to do updates, going to provide you with updates on all of these topics. There are a lot of them, but yeah, we're going to keep track of this. Hopefully, we're going to give you small bits and bites of updates each and every day to keep you up to date. So we're going to keep it here. Thanks for watching, guys. And hopefully, we're going to catch you on to tomorrow's session for another brief update. For the time being, take care. Bye-bye.
Hi, everybody. Welcome. Okay. So, welcome everybody to another episode of our series. Today we're going to talk about, more specifically, we're going to go down the road of technical analysis, and we're going to discuss, present moving average strategies. More specifically, we're going to go over what moving averages are, just a small recap. We're going to see what are, in a sense, the parameters that must be met in order to use correctly the moving average strategies, in a sense, and put them in place. We're going to do a live session after this small, let's just say, recap. And hopefully, if you have any questions, I'll be more than happy to answer them. Please let me know in the chat which instruments would you like to go over today. So it's going to be a little bit more interactive compared to the previous ones. So feel free to let me know what would you like me to go over. For the time being, I think it's time to begin. Okay, so again, welcome to another episode of our series, webinar series. Today is going to be moving average strategies. This is a small risk warning and a disclaimer. You can read this at your own time. So do that and move on straight to the point. So let's remember that there are different aspects of technical analysis, different branches of technical analysis, if you would like, or at least different techniques and tools that you use to conduct technical analysis. More specifically, today we're gonna go down the road of mechanical analysis. So in the past, we went over charting analysis, which is in a sense decoding more kind of information do individual candles are conveying to us. We discussed in the past that when you adopt or use charting analysis tools and techniques, you're going to probably come across drawing manually on a chart for resistance levels, identifying gaps and chart patterns, drawing trend lines and channels and all that kind of stuff. Today, we're going to talk about mechanical analysis, which is a different branch of technical analysis. At least that's my way of breaking down the subject. And this kind of topic involves moving averages, oscillators, envelopes and bands, and other technical indicators. Today, as you have already known or already do know, we're going to talk about moving averages and moving average strategies a step further from that. Okay, so mechanical analysis is indeed being performed by the use of moving averages, oscillators, and envelopes and bands, and many other different stuff. So the aim of the technician is, in a sense, to establish the market sentiment by the help of all these pre-mentioned tools. Okay, so technical analysis, technical analysts or chartists look for technical indicators in historical price asset data to judge entry and exit points. Again, in a sense, we use this kind of tools to provide us with at least the most accurate areas, or to detect the most accurate areas of entering, and exiting a position. So there are several technical indicators that fall broadly into two main categories. We call them overlays and oscillators. Overlays go on top of chart, oscillators go below the chart. Okay, so moving averages are definitely falling under the category of overlays, so they go on top of price action. So technical indicators are also known as technicals, and they're focused on trading data such as price, the most important, volume, and open interest. Okay, so technical indicators are commonly used by a plethora of traders, more specifically pretty much everyone. However, their usage depends upon what kind of trader you identify with. So a long-term trader might not be using heavily technical indicators. However, he might be using a few of them in brief periods of time in order to judge whether the market is moving to his or her desired direction. And in regards to the time frame of the time line or the time horizon of short-term traders, that primarily use technical indicators in much more in high magnitude, if you would like. So short-term traders do use a plethora of technical indicators, and they heavily rely on technical indicators. So at the end of the day, what you need to know is that pretty much everyone can use technical analysis to enhance the probabilities of making or placing a correct trade, or the probabilities, stacking the probabilities in his or her favor to exit the trade with the highest amount of profit. Okay, so entry and exit points are what we are looking for when we apply these kind of technical indicators to our charts. Okay, so again, a visual illustration of what to expect when you use mechanical analysis, or what kind of indicators fall under these two broad categories, which are on chart and off chart technical indicators that fall under the mechanical analysis kind of branch. So moving averages definitely go on top of price action, much like Bollinger Bands, the topic we have covered in the prior webinar. Ichimoku clouds also go on top, parabolic SAR again, same thing, and Fibonacci. So all these go on top of price action, whereas we have mechanical analysis technical indicators that go off the chart. Primarily they're all oscillators, and some of them are, for example, the relative strength index, moving average, convergence, and divergence, topics we have covered in the past. The ADX, average directional move and momentum, amongst many others. So today we're going to focus on moving averages. Okay, so what are moving averages? Okay, moving averages is essentially one of the most widely used technical indicators, but primarily because it's super easy to apply to the chart and get a grasp of where the market is headed. Okay, it's a trend following indicator, uses past price action. It's a lagging indicator, and its primary objective is to outline the direction of the trend, if that is not already visible with the naked eye. Okay, that's why we use moving averages. Okay, so if in a sense moving averages identifies whether a new trend has begun or has ended or reversed. Okay, so it in a sense tracks the progress of the trend. It does not give you information about where the trend is going to move towards to in the future. It compiles information from the past, so it gives you information about what has already happened, and this is what we care about. You want to spot as early as possible the shift in the trend, or at least make sure that the trend is moving to the desired direction, or validating in a sense that the trend is moving to the direction that we have already identified, and use that as our guiding principle. Okay, it is not telling you what's going to happen into the future. Please digest this. So in a sense, moving averages are the average of a certain body of data. This is a crude way of looking at things, but it's the most simplistic and accurate way of understanding moving averages. So in a sense, what you do is compile information about an X period of time. So for example, in this case, we're talking about a 10-day moving average of closing prices. You can choose to adjust the closing, and you can do open price, you can do median price, you can do average price, you can do a lot of things, so highs or lows. The basic way of using moving averages are built upon, the indicator is built upon closing prices of your desired X period of time. Okay, so 10 might be 20, might be 50, might be 100, might be 200. Obviously, the time period has different implications on how to judge, okay, whether a trend is moving upwards, downwards, or a sideways fashion. Okay, different time frames give you different indications, and that's why we use them in contrast with one another. So we use a short and a long-term moving average in order to see whether the trend is making the progress of shifting, or at least continuing down its path. Okay, so it uses the closing prices of 10 days in this example, and they are all added up, and then they are divided by their number, which is 10. So pure average, okay, statistical average, this is like essentially what it is, a simple moving average. So it's a body of data to be averaged, moves forward with each new day, and hence the term moving. So have 10 periods, you add all those values, all those closing values together, you divide them by 10, you get a number, and as you progress through time, you add a fresh day to your 10-day moving average and you subtract the down 11th day, you get still a sample period of 10 days. You revise your in a sense, your moving average depending on the progress of the first date or the latest date you have. Okay, so hence this is what we call the moving average. So it's not just a static snapshot of the 10 periods last year. It's a rolling forward 10 period that you have in front of you on whatever instrument you have open up in front of your charts. Okay, so by averaging the data, a smoother line is produced, making it much easier to view the underlying trend. And a short-term moving average would have price action much more closely than the long-term one. This is evidently true if you look at, for example, this. So when you have a plethora of moving averages, the ones that are closely tied to the price action are usually, or not usually, but they are almost all the time, they are the shorted ones compared to the ones that do not have the price action. For example, make a comparison between the 200-day moving average with the 10-day moving average. You see the 10-day hugging the price action much more closely because it's a shorter time frame, and it compiles information on the short term compared to the 200 moving average, which compiles information for a longer time period. Okay, this is simple stuff. Okay, so the greater the number of time periods used, the greater the smoothing, and the further away of the price action you're going to see the moving average. That depends ultimately, obviously, on the trajectory or the open and close range of price action. Okay, so if you have a chart or an instrument that trades in this kind of fashion, okay, for let's just say this is a period of 300 days, okay, so this 10 period, if you would like, is going to have a moving average much like this, whereas the 200 period, okay, or 300 period is going to have pretty much the same thing. Okay, so if the instrument is not trending, or the range of price action, okay, within this 200-day period is not volatile enough, is not moving substantially, you're pretty much going to have a similar moving average value of the 200 moving average and the 10 or the 20 or the 50. Okay, so it's the gap between the two is going to be much smaller compared to an instrument that is trending in either direction and you have sharp volatile moves. Okay, so there are three types of moving averages. Most people use a simple moving average, even though the exponential is day after day or month after month or year after year is becoming much more popular. Yeah, they have their perks as well. For example, primarily speaking from myself, I like to use exponential moving average rather than small moving average, short moving average, excuse me, than simple moving average, because the exponential moving average has the advantage of weighing, in a sense of placing much more weight on the much more recent time period, recent trading day or trading period, compared to a simple one which just averages everything out and assigns equal value to all of them. So, and that's up to your interpretation and your liking. You can use whatever you want. But the point is to understand what moving averages are compiling, what kind of information are they containing. Okay, so moving average is the follower and not a leader. Please digest this, okay? It follows the market and signals that a trend has begun, but not only after it has happened, okay? So it compiles information about the past. No leading indications are given using moving averages, okay? So this brings us to today's topic. What are the strategies that traders can adopt while using moving averages? I here compiled two, and they're super simple, and they're super easy to use and implement and understand. This is not an advanced kind of webinar. We're going to stick to the basics. So we're going to use one moving average and the example of two moving averages, and the live environment, we're going to do this. We use 2 moving average, a little bit more sophisticated than using the one. The 1 moving average is pretty much crude, but it has its own benefits. Okay, 2 moving averages are, in simple words, superior to this, and you will understand why. So the technique by using 1 simple moving average obviously has parameters. Let's discuss them. So when the market closes above the moving averages, this generates, in a sense, a bullish signal. Okay, so using 1 simple moving average, 2 parameters are price action and the moving average. So once you see the price action, once you see the price action closing above the moving average, you can use that as your signal to enter a trade. Whereas when you see the price action falling below the moving average, you can use that as a signal to enter the market, but with a short position. Okay, super simple. Crossing above of price action of the moving average, buy signal, crossing of price action below the moving average, sell signal. Now let's do the 2-day moving averages. So we, in a sense, use a short moving average and a long-term moving average. Okay, so difference in periods. So for example, the small moving average might be, for example, 12 periods, and a long moving average, might be 26 period. So when you see the 12-day or the 12-period moving average crossing above the 26, the long-term moving average, quote long-term, this generates the bullish signal. Whereas when you see the small moving average crossing below the long-term moving average, this generates a bearish signal, and the early indication that the shift or that the trend has shifted, okay, to either direction, depending on whether the short moving average is above or below the long term. Okay, so this is a visual illustration of using moving averages. Take note that we're talking about the long-term horizon of the dollar-yen chart. You can see that's what is this? This is until 2023. We start at 2020. I can't see, they're not clear enough. But still, it's irrelevant. The point here is to spot the crossings between the 2 moving averages. In this kind of case, if I ask you which one is the short and which one is the long, correct answer would have been the short one is the green line, because it matches or it trends much more closely. Okay, it hugs the price action much more nicely compared to the long one. So the green line is the SMA and the blue line is the LNA. And as we said, if you remember, when you see the short-term moving average, the green line in this case, by the way, the colors are irrelevant. You can use whatever colors you want. The point is, when the short-term moving average, in this case, the green line, crosses below the blue line, we generate what we call bearish signal. And in other words, this is the bearish cross or the death cross. This is a sell signal. So you can enter a short position here. Yep, sell. And await, okay, when the next crossover occurs. Okay, so we're talking obviously about a long-term trade here. So sell as soon as you see the confirmation with the breakdown of the price action from prior support level. After you have substantial evidence that the trend has shifted, you enter a sell position in this kind of case because you have a bearish cross, and you close the position down here when you get the next crossover, okay, which is on the contrary what we call a bullish cross, since the green line, the short-term moving average, crossed above the blue line, the long-term moving average. You can cover your position with a buy here, okay, and make this amount of distance in regards to money, okay. Whereas on the contrary, when you get bullish cross, okay, and the short-term moving average crossing above the long-term moving average, this is a bullish cross, and you enter the position long here, so you buy here, and you await for the next crossover between maybe somewhere around here, who knows, The point is you will wait for the next crossover in order to close your position and go, in a sense, cover your position, close your buy position, and get out of the market by capitalizing on this upside. Okay, super simple way, super simple strategy. In a sense, we're gonna go over much more neat and grit adjustments you can do while using the moving averages. For example, why use the not only using the crossovers as entry and exit points, but you can calibrate that and get much more and leave less money on the table by looking at different indications. Okay, for the time being, we're going to do the simple stuff, spot crossovers between moving average lines. Okay, so let's go on the live environment. Give me a few moments to bring up a chart. What do we have here? Let me see. Okay, hopefully you can see the chart. We have in front of us, what is this? Apple, okay? AAPL, Apple, NASDAQ. Let's stick with Apple, okay? And you can see this is a blank kind of chart. The only thing it has on top of it is volume. Let's add on our indicators. Let's do moving averages. Let's go with simple. Okay. So a simple moving average was added to the chart. Why is it not showing? You get it. And let's do another one. So let me get my settings up correctly. So let's do moving average, the blue line, even though it does not show for some reason. Where is it? Let me see. What is the reason why? Let's do 26. Let's do EMA. Why is it not showing on the chart? Kind of weird. Let's try different instruments. Maybe there's a problem. I think so. Okay. Give it a few moments. Reload. Okay. This is a former chart of silver. Shall we do silver? Why not? Okay. Let's go back to Apple for a few moments. Okay. So if we store my prior settings, that's good. Let's hide this and use moving averages only. So what do we have in place here? Looking at Apple, what is it? 1 day chart, daily chart. Let's spot the crossovers. Okay, let's go together. So let's see. The first one I can spot here is right down here. Okay, so we see the, what is it? The black line is the 12 period. So the short-term moving average is the 12 period here. Be adjusted accordingly. Okay, so the short-term moving average is the black line, and we have observed it crossing above the golden line or the yellow line, which is the long-term moving average. In this case is 26. You can do any period. You're going to see the difference while using different parameters. You're going to do that shortly after. So in this kind of case, this generates, in a sense, a buy signal. Excuse me. Buy signal right here. It just assume that we're going to place a stop loss order somewhere around here, so we're risking 7%, and we are waiting for the next clear crossover of the price action. Okay, this is where the first crossover appeared, which is called, in a sense, the bullish cross. See? Oh, different tool for it. Where is that lovely tool? So, in a sense, here we go long. So, I'm going to use the L. It's for long. Okay, and where do we see the next crossover taking place is down here. Okay, so we're gonna go short in here, or in other words, close our position. So this is, in a sense, what you could have, in a sense, earned while using a simple moving average strategy. So obviously it's not optimal. You can clearly see that we've left money on the table, which is what, close to 7%. Okay, so the next valid area when we saw the point where you saw the crossover was up here, but look at how sharply the price action fell. So the earliest point you could have exited this position would have been somewhere in there, which is how much? Let's see. Let's just assume it was right there. We're talking about what you see here, 35%. Superb. Okay, compared to that, while only risking 7% in order to get 35, which is what the risk reward ratio in this kind of case of 6.37. Obviously, we didn't get this. This is the actual risk reward that we had at this point in time, which is 4.68. Super nice. But yeah, 35% gain compared to the 7% expected loss if it went out the other way. So this, obviously, this moving average strategy in this kind of case works very nicely. So let's assume from here onwards that we are waited for the next crossover, which would have been somewhere in here. Okay, and the earliest we could have entered the picture was somewhere within this red candle down here. So let's do this short position somewhere in here. Okay, and the next target would have been the next crossover, which occurred right here. Okay, so this would have been a losing position. Okay, because we have chased the price action right after the shift has occurred. Okay, so leaving this position open and await, in a sense, for the next crossover would have led to a loss of, let me get my tools. Okay, this is the wrong way of looking at this. Would have been somewhere in here. So maybe we would have been broken even at best. Okay, so no loss here, break even. Okay, compared to the 35% gain that you had in this kind of trade, this is pathetic. Okay, so let's move on to the next crossover section, which is somewhere in here. You move this line out of the, no, this. I have this. I want this out of the picture. Okay, so the next bullish cross occurred somewhere in here, and we use the earliest we could have entered the picture was, let's just say, somewhere in there. When did the next crossover occur? So is here. Okay, and at the earliest you could have exited the position was down there. Okay, so let's just say 1.8% compared to this, we would have been 11. So the risk, where the stop loss for my liking would have been somewhere in here, right before the crossover. So you, in a sense, risk 3% in order to get what, 11, decent risk reward ratio. However, the signals given by the moving average strategy would have been tarnishing. You would have left a lot of money on the table, and you can see clearly from here that the best you could have had if you have played this with the signals would have been close to 2%. It's not a loss, but it's not obviously a great gain. So at the end of the day, if you risk 3% to get 2%, that's dismal. Okay, so let's move on to the next. Let's assume that We use this point right here as our as our signal for going short, because we see the short-term moving average crossing below the long-term moving average. Short position here, best entry would have been here, available entry after we saw this clear breakout, this clear crossover. The next position, the next area that I would be looking for to exit is when the next crossover occurred. It did not occur so far, and currently you can see that you are winning, let's just say 5% with this trade. Maximum you could have had so far if you exited the position would have been 9%. So we're currently at 5%, and you see Apple making headway, moving to the upside. So if this kind of trajectory continues and we see something like this, the next crossover might occur somewhere in here, or maybe up here. So the best we can hope of using moving average strategies, we get this out of the way, is maybe 4% since we went short, okay, while risking at the same time maybe this, so 2%. So this makes kind of sense, okay, to stay longer than this, give the market its chance to evolve. May see, as you can clearly see here from the pre-market value, it's 174.20, so it's below yesterday's close. May see a retracement of Apple to lower ground into this session, or on the same token side of the token, we may see running up from here. Nevertheless, the crossover did not occur, so we await, in a sense, when to exit the position when the next crossover happens. So, can we, in a sense, adjust or alter, okay, this kind of crude way of looking at things and wait for the small moving average to cross above the long-term moving average in order to go long and capitalize on the upside and close the position when the short-term moving average crosses below the long-term moving average? The examples we just followed, can we optimize this kind of strategy? The answer is clearly yes. And from my point of view, the best thing I would love to see is the usage of RSI. I combine RSI with these two moving average strategies, so an oscillator with an overlay, to give me much more nicer indications. Let's get out of the picture the MACD and leave only the RSI as my signal to exit. Let me enhance and let me bolden up the RSI in order to see exactly where I could exit the market. Okay, and in a sense, I use the two moving average strategies, the entry point, the same way as before. So I wait for the crossover to go long, bullish crossover, that the small moving average crosses above the long-term moving average as my signal to enter the position. And from here onwards, I await for the price action to do something crazy, in a sense, or in a sense, the RSI alongside the crossover with one simple moving average to time my exit. Okay, so in this kind of case, I let my position run. Okay, and you can clearly see no crossover on the horizon. However, using other indications, okay, much like the RSI in this kind of case, I await when the RSI crosses below 50, okay, it's going to match the same kind of signal that the moving average strategies are giving me, the 2-day moving averages. So my first instinct is to watch closely the RSI when it comes crashing down from overbought territory down towards somewhere in the middle of the table of RSI in the value of 60 maybe. So in this kind of case, this would have been an early signal to exit, which would have been somewhere in here. after you see the RSI crossing downwards, which obviously is not the optimal way to trade this. The next signal would have been somewhere up at the tops, where you see the RSI clearly breaking above the 70 once, which is happened somewhere in here, twice, 3 times, 4 times. Here, I'm starting to pay close attention to what's going on with the RSI and the momentum. We see a lot of build of pressure. Bulls are eager to push the price action to higher ground. As you can clearly see, the RSI is signaling over extension 1, 2, 3 times, 4 times. So I'm keeping a close eye on the RSI because it goes into over bought kind of territory and stays there and goes once again down and once again up, trades there. That means, yes, the momentum is with the bulls, but this cannot go for longer. So I'm paying close attention to the RSI and I'm awaiting whether it's gonna come back again up the 70 level. This kind of case, in this kind of case, it fails. It creates what we call a lower low, a lower high. Okay, as you can see, this peak here, we have a value of RSI value of 75. Okay, and then you see the RSI forming higher, the lower high, And this is what I pay attention to, the divergence between the RSI values and the price action. Price action here, you see it moves upwards. The RSI is giving me an early indication that the momentum is waning out, and this lower high, when I'm saying lower high, I'm talking about this is one high, this is a lower high, and another one afterwards. Okay, the failure of the RSI to match the price action, which does higher high, higher high, higher high, and higher lows at the same time. Okay, we see the divergence, we spot the divergence. When the divergence occurs between RSI and price action, I pay close attention and I'm looking like a hawk the price action to give me a sign that the price action, that it will break to lower ground. Therefore, I'm paying close attention in this area right here for an exit. And you can clearly see that when the RSI failed to record another higher high, much like the price action did, I'm timing my entry, my exit, and I exit the position somewhere in there when the first signal that the RSI is not going to go to higher ground, which is somewhere near the area that I have highlighted with this line. Okay, so this is my sign to go away, sell and go away. So best I could have had from this would have been, let's just assume my exited position here was 44%. This is 10%, almost 10% higher than what I could have gotten while using blatantly the simple strategy of moving averages. Okay, so you can clearly see that this kind of optimizes my exit point. I'm using the same parameters to enter the position, whereas the two moving average strategy, whereas I'm using RSI for looking for the RSI for a signal of divergence for me to exit my position and time it and get as much gains as possible and leaving as less money on the table compared to what I could have gotten with the RSI while using solely the two moving average strategies. Can we do the same thing with this kind of trade right here? Okay, remember at best in this kind of case, while using the two moving average strategy, at best what we could have gotten was what break even. So let's just say 0.5% gain, irrelevant. Okay, so we went short there and we are waiting for the price action to move to lower ground, and when the next crossover appeared, we would have closed the position. So once again, talking about minimal gains. Okay, not it's not bad because we're not losing money, we're just leaving a lot of money on the table. Can we optimize our strategy, okay, while using RSI? Let's see. So in this kind of case, we're looking for the complete opposite. In this kind of case, we saw the RSI trending in overbought territory. Now we're looking at oversold territory. Does the RSI give me the necessary signal to exit the position before market rebounds? We'll see. So what we see here is that price action broke below, okay, the short-term moving average closed below the long-term moving average, generated the sell signal. Best we could have entered is this. Exit was here. Could we have timed this and exited the position somewhere in here with gains? Let's find out. So RSI, okay, turns negative, okay, after this plunge. So it definitely is with the bears. However, we don't see a lower low. Okay, we see an RSI being stubborn and staying above this kind of range, which is, what is the value here? 37. It does not even come close to this kind of area. And something else to look at, is that the prior price action did this. So fresh low, okay, lower high compared to this, okay, lower low, and lower high, okay. So obviously it's moving downwards, okay. This is the intermediate kind of trend, okay. So the short signal was valid, okay. The market is moving to lower ground. Selling this makes sense. However, we are paying close attention to the strength of the selling pressure. Here we have lower low on the RSI, recording the price action, makes sense. However, after this, we get a lower high. Okay, let me make this much clearer. After this, we have a lower high. So this, the RSI does not validate the price action because we have a lower low, lower high, lower low, lower high, lower low. Does this appear on the RSI as well? No. And this is why we pay attention to the RSI for exits. This is a lower low, lower high, a higher low. Okay. If this was normal, we would have expected to see RSI coming down here, so lower than this kind of level. It did not. It consolidated nicely above the prior low. So here I'm paying close attention to exit the position. Once the RSI perks upwards and moves back towards the 50 level. So the area of my exit would have been somewhere in here at best, okay, after I see two consecutive higher lows, okay. I'm looking to exit my position as soon as possible. So maybe the best I could have gotten here is something like 3%. 3% is obviously better than 0.5% gains or no gains, okay. So this is RSI kind of optimized the trade. Obviously, the best you could have gotten was like 5%. We got 3, better than using the entry and exit points given by the simple moving average. Good simple moving average strategy. Okay, and this is, in this case, it's exponential. Okay, but still, let's do the same thing here. Entry here, exit here, market. Crossovers appeared here and here. Best we could have gotten was, let's just assume it's what, 2.5%. Did the RSI give me an early indication? Let's see. So what do we see from here onwards? RSI rebounding from the 30, a nice signal, okay? And while it's upwards towards the 70 level, okay? The failure of the RSI to do this gives me an early indication that we may see a reversal, okay, or at least the waning out of the bullish pressure, and bears entering the market kind of eagerly. Where was my signal to exit is when the RSI fails to cross the 70 bound once and then twice. Okay, so curved above it, create a new, okay, new high. Okay, second high, price action is higher. RSI is not making higher highs. It's doing the same thing. So we spotted here another. Let me remove some things off. So higher high, another higher high. This is a higher low. RSI does not confirm it. Okay, higher low, nowhere near a new higher high. Okay, new higher high in the RSI would have been somewhere up there. This is not what we get. We get another divergence with a new higher low. You can clearly spot this here. So I'm using RSI to exit the position somewhere in here. At best, I could have earned, let's just say, what, 9.6% instead of merely what is this, 2.5. Okay, so using two simple average moving strategies, you get 2.5% using the traditional methods. Using two moving average strategies to enter the market and exit the market with looking at RSI, it gives you 9%. Okay, 9.5%. So 9.5% versus 2.5%. There's no debate there. Much better exit signal is provided by the RSI compared to the average crossover. Is the same thing true for here as well? So currently, what do we see here? Currently, we are making, let's just say, 5.6%. It's not clear yet whether the trend has shifted. Can we use the RSI to exit the market much more sooner? Did the RSI provide me an indication that price action is going to start reversing towards the upside and minimize my gains, or is it favorable for me to leave the position open? Let's assess that. So what do we see here? Once again, using price action, we see a lower high. This is the new high. A lower high. Is this confirmed by the RSI? Yes, lower high. Do we have a lower low? Is this confirmed by the RSI? Not really. Okay. Where is this? In here. But it's a lower low. Nevertheless, does the new high, the lower high here is validated by RSI? Yep, maybe it's, where is it? This one. Okay, lower low. Yep, lower low is here. What about this low? Is it validated? Yep, excuse me, lower low was up here. Is it validated by RSI? Yeah, now we start to pay attention. When does the price action rebound from here or not? New high, makes sense, okay? However, price action now, okay, moved to the downside. So we have made a lower low, but RSI has made a higher low, okay? So it was ideal to exit the position here, right where we are. The fact that the RSI consolidated and made a higher low here was an early signal for me to exit the position somewhere in there and make, in a sense, what, 9% compared to the current 5%. Okay, so this would have been optimal for me in this area to exit the position, given the divergence. Once again, let me mark it clearly for you. the divergence of the RSI, okay, rather than leaving the position open. So now we left on the table at least 4%. Maybe in today's session, the price action is going to surge to higher ground and we're going to have less potential for gains. Maybe the price action is going to fall lower ground. We will see in today's session. But yeah, guys, this is how you use two simple moving average strategy. Pretty much easy, I assume, to understand. If you have any question, please send them through in the chat. We're running out of time. If not, we'll have to leave it here, and we're going to catch you on to the next webinar for another lesson. Okay, let me see. Do you have questions? No questions whatsoever. Okay, so thanks for watching, guys. Have a lovely weekend. We'll catch you on to next week for another webinar. For the time being, this has been it. Take care. Bye-bye.